Here I am. So it's a great honor to be in this dynamic world. And so the title of the presentation is Steelmakers Metallics, Manias, Machinations, Misallocations, Misconceptions, Misdeeds, and Mercantilism. A very, very important subject. So before I'm going to give you the definition of these M's, let's look at, you see that? You think the American steel industry was having its heyday today? In 1941, Bethlehem Steel was building Liberty ships. They built 2,700 during World War II, of which about 400 broke apart in heavy seas because they didn't have high-strength plate. So that was a heyday. They were employing 51,000 people. Now, if you're in the steel industry, you need a pacemaker because steel prices are cardiac arrest. And here's what we're saying at World Steel Dynamics. The current price of hot rolled band on the world market today is around $620. China's beginning a boom, a seasonal recovery. Maybe the price goes to $720 in the next couple of months. And then the production responds. Price allocates resource, and the price is going to go down to $525. I'm forecasting by about October. And in fact, that's a happy price because it's above the cost of the steel mills to produce this product, the median cost mill in China and outside. And what we see here is today there's huge profitability in the steel industry selling hot rolled band versus a price of, let's say, $620 or $600 delivered to the port. Their marginal cost before delivery to the port is only about $450. And what you see here, the price of scrap has not yet caught up with the price of iron ore and coking coal. Scrap is still a relatively cheap material. And here's a forecast for steel demand in China. Folks, it's headed down. It's going to happen, no doubt about it, as the mix of the Chinese economy changes. And here you see the incredible swing in production costs in the global steel business. And for the median cost producer, the cost is up $100 a ton today from where it was at the end of 2005. And here we see that in China, their home price and the export price tend to track together. And here's a graphic showing that in China, the supply of scrap in 2035 versus today will be up to roughly up by 200 million tons. 50% scrap recovery will be more than 50% scrap availability of Chinese production. So let me give some wild numbers. Since December 2015, the world export price for hot rolled band is up $370. The price in the U.S., hold on, is up $690. The EU price is up $560. The Chinese price is up $290. Iron ore is up $25. Coking coal is up $122. Shredded scrap, $164. Scrap delivered to Turkey, up $150. So folks, you're in a wonderful business. There's no place in the world with more excitement and complications than the steel business. It's a management business. It takes brains. You have to be proactive to survive. So now let me do something here. Okay, so let me go over the definition now of some of these items. Give me a second here, please. Okay. So let's first go to manias. Okay, before that, there's huge similarity today with the situation in the middle 1970s. In the middle 70s, steel production had grown rapidly since World War II. The reservoir of scrap was growing rapidly. Integrated steelmaking capacity was growing. But because inflation was being purged, in the next 25 years, there's no growth of steel production. And the advancing technology permitted the electric furnace steelmaker to take over ever more of the product of the integrated mills. So where are we today? Chinese steel demand by 2025 will be down 50 to 100 million tons. There's no production growth. But because of the enormous growth of production in China, the reservoir is taking off. That means the scrap price will be down, and now the electric furnace process can make almost all the products of the integrated steel companies. So it's so similar to what we saw before. Now, let's go over manias. The biggest mania probably, or big one, is that the Chinese steel companies and manufacturers are the source of all evil. China is a scapegoat. They're being blamed for everything. But in fact, the growth of Chinese steel demand in the early 2003 changed the steel industry. It rescued it. After 2008, the growth of Chinese steel demand again rescued the global industry. And what happened last year? They closed down the induction furnaces. It's a tight supply. Price of rebar takes off. And now we are having a golden profit age in the steel industry because of China. Now, machinations. There are three things you have to do, maybe, when it comes to machinations. One, you need to make merger and acquisition transactions. Bedrock Industries, a venture capital firm, invested, who knows, 6 months, a year ago, $70 million in Stelco of China. Their investment today is worth $1.4 billion. You need to have new strategies to employ technologies, and you have to defeat the enemy. Business is war. Now, what about misallocations? The biggest sin is capital spending on equipment that doesn't work. A number of companies have built primary facilities, iron carbide facilities, big DRI plants, Masabi nugget plants. These things fail because of misengineering. So what did the engineers say when the bridge collapsed? He said, "Damn that decimal point." Now, misconceptions. One is that the supply of slab is plentiful. In fact, by 2025, we've just finished a study, slab demand is going up by 25 million tons, and slab supply is going down by 11 million tons. There's a 25 million tons adverse swing for the slab buyer, believe it or not, by 2025. What about the Chinese steel demand outlook? Do you know that Chinese steel consumption per capita is 2/3 higher than the United States, yet the household income is 1/5 of the United States? China at some point will have declining fixed asset investment as a share of GDP. Demand is going to go down probably next year. Now, there's another thought. The price of steel will hold up better when there's oversupply in China. Right now, we have the tight supply in China, so 2018 will be a happy year where the price of steel on the world market will have a decline, but not a calamitous decline. But after this year, when there's oversupply in China, the price is going to drop to the marginal cost or lower than the average cost mill. And that marginal cost today is like $440. So the price of, and you saw earlier, there's a correlation between the Chinese price and the world price. Now, Chinese macroeconomic statistics, and this was about 40% of that fixed asset investment data is M&A transactions and the purchase of land. The figures are no good. We run a macro index for steel consuming activity in China. Since 2013, it's grown 10% a year. Yet our micro index, when you're looking at production of units, has been about flat. So the macro data is just bad in China. Now, the Chinese won't cut their steelmaking capacity. That's true and false. Last year, how much do you think the Chinese industry spent? They spent $64 billion. There's been very little capacity reduction net by the medium and larger sized companies that belong to CISA, the Chinese Iron and Steel Association. So once there's oversupply and the operating rates are down, it's a command economy, and they will begin to have sizable capacity reductions among the larger companies. However, they will never cut capacity enough to not wish to export. Now, the next one, the USA steel integrated steel mills are well positioned. In fact, while there are exceptions, they are facing major threats. One, you get this enormous rise in the recovery of scrap in China, the price of scrap drops, and in the US you have severe competition between the integrated mills and the electric furnace mills making hot rolled band. Then when the iron ore price drops, in the United States they have their own iron ore properties where they buy iron ore on an equity or cost basis. So iron ore comes down and the iron ore costs don't drop. Then some have legacy costs for retired workers. They're paying for retired workers. When Bethlehem Steel went bankrupt, they had 20,000 active workers and 120,000 retired workers, which they were paying pension costs and medical costs. Unbelievable. They have another problem. The automotive market in the U.S. was about 19 million tons. Last year, the electric furnace companies produced about 1 million tons. So the integrated mills did about 18. By 2025, due to lightweighting, the demand was going down to about 16 million tons, and the electric furnace companies who are using new technology, building, expanding, they'll do at least 3 million tons or 4 million tons. So deliveries by the integrated mills to automotive go from 18 million tons to 13 million tons. Now, China's steel exporting armada, it can't be defeated. It'll take a number of years, but the exporting armada will be defeated by lower demand, by mediocre costs. In China, wages have risen 13% per year, compounded since about 2000. So the labor cost in China is up, especially relative to many countries in the developing world. And new technology is permitting new manufacturing plants to have so few man-hours per unit of manufactured goods that the low wage in China or the developing world doesn't help as much Why not build in the United States where you get very low man hours and you have no country risk? And here's a wild one. I'm looking at a possibility somewhere in the United States where a steel plant can be built, and if $500 million is spent, $200 million of subsidies are available from the state and the local community, waiving sales taxes, giving credits and whatever. The United States is subsidizing new manufacturing plants on a state and local level probably more than anywhere in the world. So you should pull up or your plant in Turkey and you should move it to the United States. Definitely. Then the avalanche of trade suits is a very severe problem for the Chinese. And when will the Chinese government prevent steel exports from rising? Maybe about 2020, but that's not about to happen. Now, about steel export prices, people think they're going to hold up this year, but Chinese production of steel, which was surprisingly high in recent months because of the high price in the country, is going to zoom by June to probably 920 million ton rate versus 850, 860 today. And elsewhere in the world, there's going to be a rise in demand. The World Steel Association demand figures are notoriously hopeless. They are done by the bureaucrats in the middle of all these companies. So you should always look at those WSA forecasts with a grain of salt, and they always miss when the market's declining. And what's being missed this year is steel buyers outside of China are going to want more inventory. Therefore, parent demand is going to go up more than people think. Now, the steel industry is in a golden profit age. It'll be great in the second quarter. It'll be great in the third quarter due to the bookings at the beginning of the third quarter by good backlogs at high prices. It's heading down in the fourth quarter. The steel industry will be making the transition from the golden profit age to the good profit age. Now, we are seeing three new things today. One, we're seeing an age of protectionism, reflecting the avalanche of trade suits against the Chinese mills and others. That's new. Second, we have an amazing development. The world export price has gone up, let's say from 450 or 500 to 600, 620 a ton. But for the first time, the home market prices for steel are far above the world export price. Never saw that before. We're seeing another development. In the markets where the Chinese exports are not restricted, the price is lower than in the markets where they are restricted. Let's see where we are here now. Regarding the U.S. Section 232 tied to national defense, it's not going to be very successful. Exports of steel to the United States are $30 billion a year. Global trade in manufactured goods is $12 trillion a year. The U.S. will be suffering a rise of imports of steel and steel-containing goods. Steel slab will be moderately restrained. We have some wild developments there, but basically you'll have still a fair amount of slab entering the United States from Russia, Ukraine, Brazil. Less from Brazil than we were thinking. The price is so high in the United States that an exporter, and the current news about Brazilian slab at only 3.5 million tons permitted into the United States, will further tighten the supply in the United States of hot rolled band and sheet products. The price is so high in the United States now that the exporter can get 600, 620 a ton, FOB the port of export, pay the 25% duty, pay the importing costs, and there's still a large margin. So if the mills raise their prices even more, they're going to be getting an avalanche of foreign steel because the foreigners will be paying the 25% tariff, and there will be a lot of exceptions. So President Trump is using the Section 232 as a negotiating tool. He has a big jawbone. He's hitting all the other countries on the head with the jawbone, especially when there's a trade deficit, and they're capitulating. Now, mercantilism. Mercantilism, some may think, is dead. Mercantilism is alive and well. It was practiced by Great Britain in the 1800s, by the United States in the early 1900s, by Japan after World War II. It ended with something called the Plaza Accord in 1985, when the Japanese policymakers promised to boost the value of their currency. The Chinese have done it very successfully. They now are losing some cost competitiveness, and President Trump, whether he knows or not, it's mercantilism. He's pursuing mercantilism, holding down imports, trying to promote manufacturing and job growth. Now, what about misdeeds? One is the steel buyer, when the price was depressed last summer, who didn't appreciate the fact that the price was at the bottom. If you had read our reports, we went bullish last July. The next problem is the American steel mill who raises the price another $100. They will have too much imports. Another mistake, a misdeed, is the company who can't run their plant well when it's a unionized workforce. Another misdeed is a financial officer of a company today who's not seeking to raise equity, raise debt. Today's the time. And the other misdeed is the management that's not going to make use of forthcoming liquid futures curves whereby one can hedge the price of steel and steel products and work with customers and get far better inventory loans. So at World Steel Dynamics, we have a company called World Steel Exchange Marketing. John Conheeney over there is its president. We are promoting for NASDAQ the growth of steel futures transactions. We have listed Midwest shredded scrap, and there's going to be, in the years ahead, liquid curves. Work with your customers, take advantage of it, reduce your risk. Price volatility is not going to go away, and you can work for this for your own benefit. So the story is, thank you very much. Believe in World Steel Dynamics. Believe we're going to give you spin. We're going to give you information you can't get any other place. Thank you.
Thank you, Peter. Any questions for Peter? Check.
Thanks for your comments, Peter. My question is on iron ore. Last month, Fortescue said that iron ore miners will not be adding new capacities, and we know that iron ore inventories in Chinese ports have reached record high levels. Which one of...
What was the question?
Question is coming now. Which one of the following two factors do you think contributed most to this current situation? The slowdown in Chinese steel production? Do you want me to repeat the question?
You'll translate. I can't hear. There's an echo. I'm not hearing you well. What was the question?
So, do you think the reason for this situation is the slowdown in Chinese steel production or the iron ore glut created by the mining production boom seen in recent years?
Okay, well, you have an amazing development in China where you have 160 million tons of low-grade, low-priced ore at the ports. And at some point, they're going to modernize more of those sinter plants so they pollute less, and they're going to buy that cheap ore and convert it to sinter feed of high concentrate rather than buying lump ore and pellet at a high price. You also probably know that the big four iron ore companies have an operating cost at the port of export of about $15 per ton. And we also know that steel production is going to be peaking this summer and probably headed down. So we think the price of iron ore will drop maybe to $45. It'll still be very profitable for the large, low-cost companies. But I mean, already you're seeing in recent months that the iron ore and coking coal are flat to down and the world price is up. So we are in a new age for the steel industry. The age is a widened spread between the costs of the raw materials and their price. Okay?
Okay. Thanks.
Or
So what you're saying, the hot band price is to be $525 in the fourth quarter, and $40 for the iron ore.
well, so what's going to happen by the fourth quarter?
No, my question is, what do you guess for the scrap price?
What do you? Well, so the scrap price will probably be down 50. So your production cost for the mills, scrap will be down. Iron ore is somewhat, coking coal. So the 535 price, the price is down, but the cost is still, when you get the steel to the port of export, the cost will be less than the price. So this will be, this year, a wonderful price decline in that the margins will not be what they were, but the price will be bottoming at a pretty happy price. So if by chance they're able to, in the United States, to sustain their price, the gap between the world price and the U.S. price will widen even more, and that's why the U.S. price can't be sustained. Yes, sir.
Well, again, on the same subject of the price going down to 525 fourth quarter, are you assuming it's the U.S. as well or just the world?
Okay, well, basically, I'm talking about the world price. And the world price, as the industry has gone into an age of protectionism, has had a greater lag between the home market price and the world price. So I'm talking about the world price. And then you'll have, with different lags, price declines elsewhere, price adjustments. So China will be very sensitive to the world price. The US will be less sensitive. South America will not be sensitive. Europe will be somewhat sensitive. But again, protectionism. So I'm giving you words. Mercantilism, that's bad, right? Protectionism, that's even worse, right? It basically is a happy thing for the global steel industry. And when you're a supplier, anything that reduces supply is good. So this is a very happy, temporary, short age, and it's going to be a very good year.
So obviously you won't expect any U.S. mills to do investments to increase their capacity or because under these circumstances, is that correct?
Well, you're having in the United States, the EAF-based mills are expanding. Big River Steel is not only doubling its capacity from, let's say, 1.6 to 3 million tons, they just bought land near Brownsville, Texas, that's near Mexico. They want to build another 2.5 million ton plant. American Mills want to build a plant on the West Coast. There could be an opportunity for a company to build a plant in the lower lakes where scrap is cheap, where power can be cheap, where you have good lake transportation. And someone might build a plant in the lower Great Lakes. So you're going to be, and with new technology, the great thing about the advance in technology, the economy of scale is coming down. You can have the same capital and operating cost per ton with a lower scale. So we're going to be building these rebar mills in the United States that directly cast the billet at such a high speed that the rolling mill directly rolls a billet rather than having an independent billet stage. So the U.S. is it's a hotbed of technological change as we're seeing around the world.
Any other questions for Peter?
So folks,
I
it's
think that
been
was
an
all.
honor to be in your dynamic meeting here. Thank you.
Thank you very much, Peter.